Hello, my name is Nahid Rani, and I'm the lead tutor of Finance for Strategic Managers. And this is level 7 course, and we have so far a couple of learning outcomes which you need to achieve. So Finance for Strategic Manager, we are covering today because this is the first session, and I'm going to tell about something published financial statements analysis and for strategic decision making purpose, and which is a learning outcome 2 of our unit. So basically, the session objective of today is analyze the financial data in order to inform the strategic decision making, because as a manager you need to understand the financial information which is based on some statements, typical statements. And the scope of today's session is understand the structure and the purpose of main financial statements, and we can interpret financial statements on the basis of some calculation, because we want to do this assessment or calculation to see the viability or feasibility of the organization as well as the project. And then I will show you some ratio analysis, because this ratio analysis is the assessment of the viability of the organization, and some of the ratios are most widely used and perhaps the very influential aspects of the organization. And then we can understand what is the limitations of this analysis, and then we can explain why business needs to manage financial information. Basically, as we know, the purpose of published accounts is to provide information to shareholders and relevant stakeholders, users. For example, potential shareholders, managers, employees, lenders, bankers, creditors, suppliers, customers, community, competitors, and then other users. And we need to know about this information to manage internal accounts and to meet the stakeholders' requirements. On this task, because we are covering task 2, and then we are covering the financial statements analysis. So why we produce accounts or statements, the basic questions or requirements, because we need to provide information for the users, that's our stakeholders, to make the economic decision, to make a strategic decision, to make any kind of decision for the business. That's why we need that kind of information. And then we need a record of very substantial record of how a business has performed financially over time, because we need to submit our report to the HMRC and the different regulatory bodies. So we need a very comprehensive record, and that the accounts and statements produce a very comprehensive record for the business. So when we do a business, basically we are looking for the profit and how the profits calculate, because there is a cost and there is a revenue. So how we make a profit, let's see a very basic and simple exercise. So Mr. Jack, who is a business man, doing a small business, and he decides to use eBay for a new business, and he purchased 6 sweaters from the eBay Crosby bulk wholesalers for £10 each. So the total cost of the 6 sweaters is £60, and he thinks he can sell them £15 because his buying price is £10, and then he decides to sell it at £15 each. So how many sweaters does he need to sell to get his money back? So that's a very basic profit calculation. And he sells all the sweaters. How much profit has he made if he sells all the sweaters? So this is a very basic concept of profit. And then we will see this kind of transaction, how it's going to record in the ecosystem or statements. So that actually incurs other cost of eBay listing cost of £12 in total and delivery postage cost of £1.50 per sweater. So definitely there is a gross profit and then the net profit after the selling expense. So, and then if you think that if there is a difference if a customer pays in weeks time, that's the creditor's period. So we need to record these things in our accounts periodically. So let's see how it works. So because it's sales £50 each of 6 sweaters, that's £90, 6 times 15, and then we deduct the cost of sales because we bought Jack bought each sweater £10 each, that's a £60, and this is the gross profit. But we have, sorry, Jack have a selling expense here because when he sold this item, £15 each or 6 sweaters, he has got some selling expense. You see, there's a postage to the customer, just £1.50 each. eBay cost for £12, and then this is a selling expense. So gross profit was £30, but the net profit is £9 because there is a £21 expenses over overhead costs. So this is actually the next £9, and that's called the income statement. On the income statement, we see the sales, we see the cost of goods sold, we see the different kind of profit. Now I'm going to show you the different kind of income statements. For example, so this is the income statement. So in the income statement, the organization need to produce periodically sales, cost of goods sold, and then we get the gross profit, and then we get operating. See, the different kind of profit are here: gross profit, operating profit. Sometimes it's called net profit. Then profit before tax. When we deduct the interest bank loan from the operating profit, then we will get the profit before tax, and we have a profit after tax, and we have a retained profit. It's called the retained profit. Okay, so this is this income statements, and we need to know each item of the income statements, what's the head of the income statement, and how it comes from. Now let's see if Jack decides the different things. Final income statement from the we showed you that. How Jack get the profit from that transaction. So that's the final income statement for Jack. So sales less operating profit than cost, that's the profit. But in between here we have overhead cost, which is deduced from the operating cost, that's the net profit. So main statements actually we need for the consecutive years, the balance sheets or the statement of the financial position last year, and then it will come this year if we want to make any comparison. For example, if you have a last year statements, then we can compare it this year, and then we can project our endowment expenditure for the next year. So that's why we need the financial accounts, for our business, and then we need to publish the financial account statements for the stakeholders. So we need for the financial statements for 2 projects for the next years, and then for the comparison with the previous year. So who are the stakeholders basically, and then who are the primary stakeholders and who are the secondary stakeholders? So if you see, there's the owners of the business, internal employee and the business owners, the first stakeholders of the business. They need to know what's going on in the business. Management, team, staff, customers, definitely the direct relationship with the company, suppliers, direct relationship with the company, competitors, government. These are the very basic stakeholders of the company. And then pressure group, who made the budget, and then who made the pricing, who made the everything, levies and taxes and VAT, excise duties. There's a pressure group's opinion are always important for the business and the organization. So there are the two types of stakeholders in the business, normally the primary and the secondary. The primary stakeholders are those with a contractual relationship with the business, for example, senior employees, directors, managers, shareholders, customers and suppliers. They have a contractual legal agreement with the business, builders, local planning authority, because we need to pay tax to the government, bankers. There is a lending borrowing relationship with the business. That's the very primary stakeholders of the business. And the secondary stakeholders are environmentalists, local residents, local schools, local authority, competing business competitors, highway authority, parking for company. So these are the secondary stakeholders who have the indirect relationship with the business. And then primary stakeholders, direct relationship with the business, but all the stakeholders are relevant to the business, and they need to see what are the business going on in terms of financial information and accounts. So as we can understand, what is the profit, and that goes to the income statement, sales less costs, and then when we deduct the cost, there's a different kind of cost. Administrative cost and capital costs and other things. So we can deduce the different kinds of profit: gross profit, net profit, operating profit, which is net profit, and profit before tax, profit after tax, and retained profit. Basically, income statement of financial position, cash flow statement, and then forecast projected cash flow. So these are the main accounting statements. And then the income statement shows the profit and loss of the particular period. And statement of financial position shows the assets and liabilities position in the business. And then it has to be recorded periodically. Cash flow statement shows the cash inflow and outflow in the business, apart from the working capital, because how many cash are coming to the business in regular basis and how many cash is going from the business. That's very important to estimate and need to show in the projected figure. So these are the main accounting statements we need to produce every year, periodically, monthly, quarterly, weekly, depends on the business objective. And then we understand who are the primary and secondary stakeholders on the basis of contractual and non-contractual obligations. Now, Jack has decided two other things. There is a different profit, as I saw the income statement. There are the different levels of profits and the different stages of profit. So he purchases 15 sweaters from Crosby Blow wholesaler, and then total cost. We calculate here the 10 sweaters 60 pounds and 15 sweaters must be the more than 60. So he thinks he can sell them and then now he decides 25% markup on cost. And how many sweaters does he need to sell to get his money back? So if Jack's think that he needs 25%, 35% or 50% markup on the cost, so how many sweaters does he need to sell to get for the profits? He sells all the sweaters, so how much profit has he made? So this kind of information can he get from the accountings. So he actually incurs the cost of effecting cost of 8% of sales and delivery process of £1 per sweater, because the more he sells, the more he reduces the admin and selling costs, and then the profit will be changed. And what it make any difference if a customer pays in a week's time, so he gets a week credit is supplied. So that's the ratio analysis. So if the raters and creditors periods are delayed, or it depends on the day and particular period of time, then how we calculate and interpret that terms figures. So now different income statement for Jack again, because this is 15 sweaters and £15 each, 225 the total sales, and then the cost of sales is £180, and here is the gross profit, but the postage is reduced £1, and eBay cost is 8%. That's the 33%. £33 of the selling overhead cost, and then now the gross profit will be 12. Gross profit from 45, and the net profit is £12. So these are the different types of overhead costs, and depends on the sales. And then now these are the statements I have showed you before. These are the income statements at a glance. So you need to have a sales, cost of sales, and then you have admin and other expenses. That's overhead costs. And then when you deduct this kind of cost from your gross profit, you will get the operating profit. And then you will get different kind of profit before tax and after tax, and you have a written profit for the year. So you can do it in periodically, monthly, quarterly, fortnightly, weekly, half-yearly, and yearly. And then you can project your sales, your cost of goods sales, and then you can estimate your different kind of profit from the income statements. Now, we will go for ratio analysis. Before we go to the ratio analysis, we need to see the balance sheet. So what kind of balance sheets are providing to our business, and then what it looks like. Sorry, Excel sheet. So balance sheet is like assets and liabilities information when from the balance sheet, and the statement of financial position is interchangeably used, the term. So some countries they tell balance sheet, some countries tell the statement of financial position. So because in your assignment you need to do Samsung PLC published account, and you need to download all the balance sheets of Samsung PLC and profit and loss accounts. So in the asset side, we can see the non-current assets and the current assets of a company, and that asset side will be equal to the total capital and liability side. The assets and liabilities should be equal. That's the balance, and sometimes it's called the statements of financial position. So here we can see the stock position, status, and bank at cash. We can see the share capitals in the capital, and then we can see any kind of loans, and then other current liabilities like creditor, tax payment, overdraft. So these are the glimpse of the balance sheet. Now we are going to analyze the ratio analysis from these two statements, and then we will calculate some important ratio analysis. So ratio analysis is a mathematical expression which is related number to another and providing a relative comparison. Basically, the ratio expressed in these two dots, this type. So you have a two different figure, and then you are comparing each of with other. That's the ratio. And ratios helps to link the financial statements together and offer figures. You have a figure from income statements and the balance sheet that are comparable between companies across the industrial sectors, and the most importantly over the period. So you can compare your figures from the last year to this year, and you can project your figures for the next years. So normally the ratio analysis is a big company, because you're doing on Samsung PLC, you need to take at least 3 years data, and then you need to compare between the periods over the years. So the purpose of the ratio analysis is to identify the financial strengths and weaknesses of the company. So from the if you calculate the ratio, we can understand the strength and weaknesses, because there is a number and we need to interpret that numbers to identify the weaknesses and to identify the limitations, and as well as the strength of the company. We need to understand the financial position of the company and to analyze forecasts and budget and trends compared to history, competition, and other factors. That's the main purpose of the ratio analysis. And the source, as I can say, that's all the published account. We can use that income statement in a statement of financial position, typically called the balance sheet, and cash flow statement. From that statement, we can source the ratio calculation. Sometimes, if you want to do some like a sales per employee, sales profit per employee, so employees' position, you need to ask to the HR department to get the exact figure. Some other related department will provide you the number. And there is the limitations of the ratio analysis. You need to say about something of the limitations of the ratios in your assignment. So there's a different company follows the different accounting policies. There is no standard prescribed formulas and policies for according to the accounting. So there's accounting policies limitations. And then when you compare different sectors in the different types of trade and year and date, that will be the different. So that's the one limitation. So when you compare date-wise, you need to be take similar date from the account statements, and they did similar trade. And then there is a size of a company and stages. Before, for example, if you compare the Samsung company with a very local phone company, that will be the very heterogeneous comparison. So these are the limitations: size, growth, stage, and type of trades, and year-ending dates, and different kinds of accounting policies. These are limitations. You can't accommodate these things in the ratio analysis. So let's see what kind of ratios we can investigate today. So there is a profitability ratio, there is a financial ratio, there is activity ratio, employees ratio, investment ratio. So on the profitability ratio, you play with the profit, and then we have a gross profit ratio, you have a return on sales, operating profit, or net profit ratio, return on capital employed, so that you can compare the total liabilities and assets, current liabilities, different things. So then you can explain profitability ratio, the margin of different types of profit income. Financial status ratio, that's the solvency ratio, that expresses the short-term and long-term, preferably the short-term solvency status of the company, and then it means how quick the company can pay off its short-term obligation. That's a very important ratio, current ratio and quick ratio. It can have some activity ratio. The activity ratio measures the rate of which the company is turning over its assets and liabilities. So, for example, if the company wants to see its partner company which is staffing level, employee ratio helps to see. That's the employee ratio. So, activity ratio, if you want company want to see what's the stock position, how many days they can hold, and then debtors period time and the creditors period time. That's the activity ratio. And if the company wants to see its performance compared with the staffing level, that's the employee ratio, helps to do in a deeper look per employee sales and per employee profit. And then investment ratio is mainly applicable to the public companies, with a limited company, to see the growth and the difference for the investor analysis. So what is the share price in the market? So we can estimate that one. So these are the basic ratios. So you can calculate it from the income statements and the statements of financial position. So let's see the profitability ratio, and the formula of the profitability ratio is gross profit divided by sales. Where is the gross profit is? Gross profit is from the income statement. That's the source of the calculation, and the sales, you can get it from the income statement. And when you express this gross profit ratio, then you have to use the percentage. Sorry. And the return on sales on the normally the net profit margin, and all net profit margin, we always say that the operating profit and net profit margin is same. So return on sales, operating profit, and the net profit margin are same, and using simultaneously in the business. So when we divide operating profit by sales, then it will our net profit margin. Okay, return on capital employed. So we know our capital employed, total asset, and the minus current liabilities. And then when we divide loans by capital employed, then we can have the return on capital employed ratios. And then this figure will come from balance sheet, and then this figure will come from the total asset and the current liabilities. That is from the income statement of the financial position. So these are the three types of profitability ratios. Normally the gross profit and net profit call the profitability ratios, and which is the margin of different types of profit and income. So let's see the liquidity ratio, the next one, which measures the production efficiency. So that interpretation, when we go to calculation, then we do the interpretation, because the interpretation, without the interpretation from the ratio, it tells nothing, because you have the figure, but you need to make a proper interpretation. And as far as your assignment, you will calculate some ratios, and you need to explain what the numbers are saying. So for example, the gross profit measures the production efficiency and reflects the pricing decision from product costing. And if you have the figure, then you can explain and then compare with the previous years, and then you can forecast it within the company, and then you can compare with the other company if you want to get a good marks on your assignment. These are the interpretation of the gross profit and gross profit margin ratio. Normally, when we get the yardstick of the 30% on profit, 40% gross profit, that means like 100% profit. When you deduct the gross profit figure, then you have a remains. That means the remains of the revenues generated by the farmer used to pay is for cost of goods sold. That means if you have the 30% gross profit, that shows 70%, 100 minus 30, of revenues generated by the farmer used to pay for the cost of goods sold. And there is no general yardstick. It depends on the industry. If it is a big industry, need a good less percentage of the gross profit, and should be stable over the year. If it is fluctuate, then you have to think about why the different fluctuation on the gross profit in terms of the business operation. So there is interpretation of the sales ratio, and then it can be calculated by the operating profit divided by sales. And then this is a fixed, that should be the stable, the 10% net profit margin, but depends on the type of industry. For example, if it is a low return, 2% of the net profit or the operating profit percent, it doesn't necessarily mean a low return on capital employed, as if sales volume is high. So it depends, and it's a very relative aspects how you explain the return on sales or the operating profit percentage in terms of size, business, operation, and other indicators. So for example, if your net operating profit is 18%, that means when every £1 of revenue is generated, that 18 pence is left after deducting the cost of goods sold and the operational expenses. So you have a remaining amounts from £1, that's if it is 18%, that's 18 pence left from the every £1 of revenues generated. So this is the explanation of the operating profit margin calculations, and then you have to express from your data in financial data and the ratio calculation you have to explain this way as interpretation. Now if you go to solvency ratio, because this is a liquidity ratio, and the liquidity ratios are some of the most widely used in ratios, perhaps the next to profitability ratios. And these are there especially important to creditors, because they need to see how much the short-term efficiency to the farm's ability to meet its short-term obligations. The level of liquidity ratios needed varies from industry to industry. Certain industries are more cash intensive than the others. For example, grocery stores will need more cash to buy inventory or stock constantly than the software firms. So the liquidity ratios of companies in these two industries are not comparable to each other. As I said, that's the limitations of the analysis. You can't compare the one from like in a different heterogenic ways, and it is also important to note a company's trend is liquidity ratios over time. So as we have a current quick ratio, and then in the sources of the ratios, current ratios is a statement of financial position. We can get the current asset and current liabilities, and when we divide by each other, then we will compare by 1, and the metric is 2:1. For the quick ratio, when we have the current assets and when you less the stock or inventory, then you will get the quick ratio after the current ratio. When you less stock from here, this formula, then you will get the quick ratio. So the current ratio always be examined in conjunction with the acid test and the guide to 1.6 to 2.1. That's a standard metrics. And then acid test, or sometimes it's called, and this measures the ability to company to pay its very short-term liabilities out of its short-term liquid assets, usually current assets minus stock, and then yardstick is 0.6 to 1. Current ratio measures the short-term solvency, and that there is adequate short-term assets to cover short-term liabilities. And as I said, that should be about 1.6 to 2:1. So 1, in between 1.5 to 2, that takes a standard. They are maintaining the short-term obligation to pay its current obligation. And if it is very high, for example, the more than a 2, then the company may be stable, but they are inefficient. They're inefficient to use its current assets. As I say, the current assets minus current liabilities divided by current liabilities. This is the quick acid test ratio calculation, and this is more important and critical. And if the creditor wants to see how quick the company can pay its short-term liabilities, and then should be 0.6 to 1, and shows the ability to meet very short-term creditors out of short-term money in the bank or due in. So, for example, a supermarket or grocery may have a very low ratio, say 0.4, but it's compensated by a high stock turnover and little or no credit given. So that's relative matter. So which industry and which company you are doing the ratio calculation, and how you are going to interpret on the basis of size and growth of the business. There is the efficiency review as well, that activity, and then you can take inventory, stock days held. So if you have inventory and if you divided stock of sales, and then can have the number of days, and you have to multiply 365 days, and then you have a receivable dates, trade debtors divided by sales in times 365 days, and then you can get the number of days. You have also creditor ratios, so then the payable you need to pay to the creditors, trade creditors divided by purchase, multiply 365, and then the number of days. These are the efficiency ratios, and you need to, because these two things need to be the less number of the, we assume that the more less than the 60 days is a standard, and then you need to pay to your creditors. It's set with the creditors, and normally the 60 days time period for the debtors and creditors ratio, the standard time. And then you can have some information from the HR department, the employee, the number of employees. When you divide the number of employee or sales, then you can have the per employee sales, and then you have a per employee operating profit. And it's a very simple indicators to look deeper at staffing levels with financial performance. And then you have investment or strategic investment ratio, which is you have earning after tax before the return earnings. And if you divide its number of shares, it will, because you need to pay some dividends to your shareholders. So not easily comparable between the companies when you interpret, and then should show the growth of the year. So when you see the earning per share is increasing or decreasing, it will tell you the growth stage. And then definitely the stock market is related with the earning per share, and then you can explain it with pence. So what is the price of the per share, and then that was the earnings per share, the number of shares issued. So you have one assignment need to submit for this course, and then you need to explain the ratios things in your assignment. So let's see how you are going to calculate the ratios. So as I say here, the 12 to 13 ratios I have showed you: gross profit margin, net profit margin, current, quick, stock days, day-to-days, creditor days, and then you have a sales per employee, profit per employee, earning per share. So how you are going to calculate this? So let's see the calculation. So if you see the gross profit margin and net profit margin, the ratio will be calculated here. I will show you. Before that, on your assignment, you need to show kind of these things, like you have to mention all the ratios here, and then you have to calculate all the ratios from minimum 3 years. So if it is a Samsung PLC and you download all the annual report from the website, and you need to mention the year, and then you need to calculate the ratios here. Now, here I'm going to show you how we are going to calculate the ratio. So gross profit margin, as we know, the formula is gross profit divided by sales. So here, if you want to calculate in the Excel sheet, you always start with equal sign, and then take the sales. So we need to take the gross profit first, because the figure is gross profit divided by / by sales, and then you will get the gross profit margin. Because it is indicator is percentage, then you will use the percentage sign. So you multiply 100, and then net profit equals, because net profit is our operating profit, so take that amount, the operating profit, divided by your sales, and then you will have your operating sales. That's 13%, because it's 128, so we can take 13%. Because I made this column with percentage. Now, you want to see the return on capital employed, and that's the calculation is loans divided by current assets minus current liability. It's total assets. Total asset minus current liability. Let's check. Loans, the return on capital loans divided by total asset minus current liability. So our loan is, so go to the balance sheet, and then you can see the loan. So our loan is 25,000. Click on that cell, divided by total assets. So our total asset is this figure. This is our total asset minus our current liabilities. This is our current liabilities, and the figure is 34,000. So I need to put a bracket. You can do it in your calculator, because I have the figure here, so that's why it's happening. That's the figure. So loans divided by total assets minus current liability, because I'm using the bottomless formula. That's why I need to use the first bracket. So return on capital employed, and if we go to the percentage wise, so it would be 27%. So that's a return on capital employed. Now the current assets divided by current liabilities is our current ratio. So current assets, if you want to calculate in the Excel sheet, you need to put the figure in the cell, and then you can take the cell reference. So equal current asset, where is our current asset? Our current asset is here, and then that's our total current assets divided by current liabilities. So where is our current liabilities? This is our current liabilities. So take that cell reference and then hit the enter, then you get your current ratio. That is 0.89, 0.9 basically. That's 0.9. And then when you get the quick ratio, then you need to take out the current asset from the date store. So current asset minus, where is your stock? That's your stock. But you need to put the first bracket on it because you're using the Bodmer's formula. And then you divide it by current liabilities. That's our total current liabilities. So quick ratio is 0.3, which is more than 5 here, so we can make it a 0.3. Now the stock days equals the stocks divided by cost of sales. So equal our stock, this is our stock, divided by our cost of sale, that's our cost of sales, and you put the minus bracket, if you're multiplying 365, so multiply 365, so using the multiplication you need Starish, the 365, and then you hit the enter, and you get the date. Because it is a day, so you need to round the figure, so current day 32.58 days, so it should be the 33 days, and then datus, take the datus divided by your sales, and then you put the first bracket on it, and then you multiply with 365. That's your dated days. It should be 11 days because it's less than 5 after the point decimal. Now creditor days is equals your creditor, that's your creditor, divided by your cost of sales, and then you put first bracket, and then you multiply 365, because that's our standard formula to calculate the creditor days. Then you hit the enter, and it's also 24 days because it's less than 5 after the decimal. So 24 days, this is 11 days, and this is 33 days. Now here you have information of number of employees, so you can directly calculate the sales per employee. So equals, so this is your sales figure, take the cell reference divided by number of employees, so that's your 12, and then you hit enter, that says 26667, so we round the figure. If you want to round the figure in your spreadsheet, then you can use this one, it will go this way. So operating profit divided by employee, that you will go with the profit per employee. The operating profit is our 41,000 divided by our number of employee, and then you make it round figure, then go this way, and then it will give you the round figure. Now earning per share is a profit after tax, this figure, so equals profit after tax divided by number of shares issued. And now where you get the number of shares, if you see the share capital, if you have a total number of shares and then each price of the share, so that's a 20p, and then number of share issued is 250,000. So it should be 250,000. I'm going to write it down, 253,000, and then it will give you the 9.2 pence. That will give you the 9.2 pence. So now in your assignment, Samsung PLC, so you have to download the income statement and the statement of financial position for 3 consecutive years. Minimum, you can do more than 3 years. That will be the good and report, because you are producing one report to show your stakeholders to analyze the statements for the strategic decision making. So when you get this result, you go this way. This is the figure we have calculated today. So you can see that these are the figures I put already, and this is the previous figures calculation. So you have to show each year all the calculations, and then minimum 10 ratio calculation in your assignments, and you have to figure out this. And I will upload some e-resources to your Moodle area as soon as possible. And then let me know how it's going on, and then if you have any query or any questions, you can email me. So this way you need to calculate all the ratios, and you need to figure it out in one spreadsheet, and you need to interpret in your report what your figures are saying. So you can interpret this way. So from 2016 and 2017, the figure has been increased 2%, 30 minus 28. So it's increasing. That's also net profit margin is increasing, and then return on capital employed decreased. So you can show and tell why it's decreased, and you can compare with the previous year to this year. And then when you have the more years here, the figure, then you can show the graphs or kind of pie chart or anything, and if pictorial presentation, that will be good. And then you have to say something to your stakeholders what your numbers are saying as per interpretation, because these numbers says nothing unless we have a financial knowledge, because you are producing this report to the primary stakeholders as well as the secondary stakeholders. It must be comprehensive. You need to express all the ratios, what is telling and what the results, and how you interpret, and what is the implication for strategic decision making, because this is the most important aspects of the finance course. You need to interpret the financial terminologies and the figures to the stakeholders. So you need to download the income statements and the balance sheet from the website, and you need to show some calculation. So, and you can make some like this kind of sheet in your spreadsheet, and you have to attach in your appendix. But I would prefer you need to make a kind of reporting in your paperwork, and then in your assignment you need to show the table of the ratios and the interpretation in your original report. So these are about the the assignment talk. So you need to visit your Moodle area and then read carefully of the task 1, 2, and 4, because you have to submit nearly 4 tasks. And then if you do this task 2, because these lectures based on the task 2 and the learning outcomes 2, you need to email me. This is my email address, drronnie@ukversity.co.uk, and you can call to our office number. So basically, you are going to produce a report to the stakeholders, and following the 4 different learning outcomes, and you have to fulfill the criteria, because on this learning outcomes too, where you'll be able to analyze financial data for an organization in order to inform strategic decision making. You have to interpret financial statements to assess the viability of an organization. So you need to explain a bit on financial income statements and the statement of financial position and what is the purpose and how you are going to interpret these different figures. That's the one criteria we are going to assess. And then you have to make a comparative analysis of financial data using ratio analysis. And I have showed you here different kinds of ratios, 5 basic heads. And you have to calculate minimum 3 years ratios, and you need to interpret. And without the interpretation, your ratio tells nothing. You need the interpretation from your exact figure. You have on your task too, you have opportunity to get merit and the distinction. So if you want to make a merit work, so you need to have some further recommendation on your conclusion and analysis to an organization based on the analysis and interpret of the financial information. And then you have to assess the limitations of ratio analysis as a tool for strategic decision making. So what's the missing, what kind of information you can't make any strategic decisions. If you tell something on about this, then you will get the merit marks. On your distinction part, you can recommend to the management team, so what need to be adjusted, cost, sales, profits, assets and liabilities, debtors or creditors, or loans or interest. So if you justify some recommendation, and if you can include some methods and tools that allow businesses to analyze financial data for strategic decision making purpose, then you can get distinction mark. So what I could suggest, can you just visit your Moodle area and you can email me to what you need to know. And you need to read something ratio analysis and what is the basis of the ratio analysis and how you are going to calculate of the ratio analysis. And then you can make a first draft and you can submit to me for the formative assessment, then I can give you one feedback. Or you can make an appointment with Join Me, and if you email me, then I can give you a possible timetables, or you can call to our office number, then we can discuss over the phone. So hope you enjoy this session and the lesson for learning outcomes to analyze the financial data for an organization in order to inform strategic decision making purpose. So read all the PowerPoint presentation slides and go to your Moodle area and visit any ebooks there, and then let me know what is you're struggling, and then if you need any help and suggestion or any support, please email me freely, and then I'm happy to pick emails any time of the day. Thank you so much. That's all about today's lesson. Enjoy the finance. Thank you.